Vinay Khattar is Executive Vice President, Head of Research at Edelweiss. He is now joining us. Vinay, hi, good afternoon. Thanks a lot for joining us after a bit of a break. Good to get chatting with you as always. What have you made of the recent moves, Vinay, in the market and the kind of pickup that we have seen from the lows, especially in the broader market where the mid-cap index has sort of recovered almost 10% from the lows?
So the way we see the markets is like this. A lot of our troubles are imported. You have a significant pressure which is building up globally because of the US problems of high inflation and the need to take the liquidity back out of the system, so on and so forth. As far as India is concerned, our own story is not so problematic, though our inflation is on the higher side, but a chunk of that is imported inflation driven significantly by fuel prices, which are a large factor of Russia-Ukraine problem. If you go beyond the headlines, which are fairly sober, if you go deeper and look at what the conversations were in the month of December, January, February, we were talking about a massive capex cycle picking up, demand being very strong, e-toll collections being at all-time high. The monthly run rates were upward of 4,000 to 4,500 crores. GST tax collection at more than 1.64 lakh crore on a monthly basis. Power demand surging. I mean, if you look at last 7, 8, 9 years data, power demand has actually grown at 5.5%. On a sustainable basis for last few months, you were looking at 8.5% kind of growth. And suddenly the PLFs on thermal plants, which were just at about 55%, had shot up to about 75%. So the domestic economic strength was huge. And because of that, our sense was that Indian markets should not get punished as severely as some of their Western counterparts. And whenever things abate on the Western front, probably you could see a lot more recovery playing out in Indian markets. And if you look at the broader market post the correction, I think the broader markets are showing some strength. And you could get some very interesting bets at these levels.
Okay, all right. Hi, Vinay. Thanks so much for joining in. Putting all those factors down, what you mentioned with regard to the global setup, the domestic setup as well, how would you view the market from here on? Would you be a little bit more cautious, or are you turning constructive? Go ahead.
So, Nigel, the way we see it is, let's look at the inflation print that is likely to come in. It's likely to be at 9% for US, will happen in a couple of days. Fed is already at 1.75% on Fed fund rate. 75 bips is a given for the end of July policy. So you're sitting on 2.5%, which is factored in by the market, maybe another 50 to 75 bips happening. On the US 10-year bond yields, we have had a top at about 3.4. The bond yields are headed downwards. So our sense is the global markets will probably pause a while as the interest rate hikes. You move from 25 bips to about, let's say, 250 in a span of less than 6 months. So the global markets will wait a while. We'll see the impact of inflation, the hike in interest rates pass through the system, probably inflation come down a bit, and a lot of negative factors will at least have an interim high, which could then cause, let's say, indices like Nifty to find bottoms. Our sense is 15,000 to 15,500 are reasonable levels to do bottom fishing. Look at it like this. Nifty earning for FY24 is likely to be about 1,018 as per right now the consensus estimate. We have had 6 quarters of upgrade in Nifty earnings for FY24, which is one of the longest runs we've seen in recent past. Last quarter, there was a minor downgrade. This quarter will be the primary one where we will see impact of commodity prices and probably some degree of demand coming in. But our sense is that 1,000 rupees EPS for Nifty for FY24 should hold and hold well. We are not in the camp where this number could come down by 10, 15, 20%. Definitely not. As the Nifty EPS of 1,000 rupees holds, Nifty levels of 15,000 could be 15 times forward multiples, which are fairly low levels as far as the Nifty trading is concerned. Nifty normally doesn't go below 14.5 times on the forward multiples. Second important factor is 2 months down the line, that is, as you cross over into September, market will seriously start looking at FY24 numbers as the roll. So broadly, our sense is 15,000 to 15,500 should be strong levels where investors can deploy at least 20-30% of their capital and wait for next set of cues to emerge out of either global markets or from India for further deployment.
No, got that. Vinay, would you want to? I mean, you know, your coverage universe is pretty wide, and there has been a fair bit of large caps get discussed all the time, right? I mean, they're the largest sectors. A bulk of the investments are in those sectors, banking, etc. I mean, it's also consensus overweight. But because you have such a wide coverage universe, are there any sort of large outsized opportunities which you want to kind of detail out for our viewers? From mid caps, small caps?
So I want to give a couple of names. One is on the mid cap side, another is the large cap banking that we prefer. So on the mid cap, I think one of the companies that one could look at, and it's a kind of a largest mid cap, is in the real estate side, which is Brigade. It's been one of our top ideas over last year or so. So Brigade has, so let's look at the opportunity. I think real estate is one of the sectors which is likely to do fairly well. We've had a 7-8 years of down cycle. Last 12 to 24 months, we have seen sustainable and multiple factors playing out, whether it is consolidation of larger listed players. Their market share has doubled from almost 9% to about 22%, to a sustainable demand driven by IT sector doing so well. Brigade has significant presence in southern part of the country, where we see factors like strong IT demand clearly playing out. Second, in a company like Brigade, where there are multiple segments, so there is a residential business, there is commercial, and there is hotel. All the three segments are doing very well. Commercial vacancy rates are down, rates are beginning to inch up. There is a lot of demand and strong demand coming out of there. On the hotel side, both the ARRs and the vacancy rates are moving in their favor. So our sense is, in a very volatile market, when you have two strong cash flow business, which is hotels and commercial, the bottoms are in place. And if the markets do well, then you get a disproportionate upside. So low risk and high reward kind of bet plays out as far as the Brigade is concerned. The other one that we really like at the current price level is HDFC Bank. It's been an out-of-favor bank, one of the largest, best run over last 2-3 years due to multiple challenges on the technology side, and then RBI taking some punitive action and so on and so forth. And in the post-Aditya Puri world, the bank's stock price has taken a beating. At current level, at about close to 1400, 1450, the bank is available fairly cheap. So if you were to just minus off the HDB, which is a subsidiary, you take out about 170 rupees worth of book value. So the bank is available today at 1230 rupees. Now at 1230 rupees, the company is likely to do a book value of about 600 or close to 600 in FY24. So it's available to you at 2 times. This is one of the lowest levels that I can think of in the recent memory that the bank has been trading at. Credit cycle per se is coming back very vigorously. Bank is focusing a lot on tier 2, tier 3 towns in terms of setting up branches. Now, this is a structurally different call that the bank is taking. While most of the banks are moving hugely in forward of technology realm and trying to bring down their cost to income, HDFC is saying that I'm going to go to tier 2, tier 3 towns, open large number of branches and corner disproportionate amount of CASA, which we all know is a big edge in the banking space. So as far as the business goes, our sense is such a large book, credit growth picking up across the system, HDFC Bank could come back with a lot of vigor, and pricing is very suitable. So can you get 20 to 30% easy money on this one over next 12 to 24 months or more like 12 months? Possibly, yes.
Okay, Vinay, thanks a lot for joining us. Good talking to you as always, and hope to see you more often. For now, we'll take a break and we'll come back with the market closing.